So we just have colleagues joining, and we'll be starting in just a minute. And so welcome to today's webinar, where we are delighted at ZN to be linking with the Dubai International Financial Centre and their partners, the Global Ethical Finance Initiative, the Institute for International Finance, to discuss a really important issue, moving the finance industry from promises to action. We have a great lineup for you today, including Ali Al-Zaruni, who is the Chief Operating Officer at DIFC, Sonia Gibbs from the Institute of International Finance, Omar Sheikh from GEFI, Christian Kuntz from the Dubai International Financial Centre. For those of you who haven't met me before, I'm Mike Wardle. I'm the Chief Executive Officer at ZN. And we've been thinking at ZN about sustainable and green finance for some years. And in 2018, we launched the Global Green Finance Index, which tracks financial centre performance in green finance. And we've learned, I guess, through looking at the financial world through the lens of financial centres and green finance, first, that we continue to see a sector driven by policy, public policy initiatives, which are still driving green finance, and which is the strongest still in Western Europe and North America. But we are starting to see other centres across the world really picking up the baton. So in Asia Pacific, in the Gulf region, other parts of the emerging economies, we are seeing financial centres make a drive to embed green finance. And as we look forward to COP28, the role of finance will be in the spotlight. A few housekeeping points before we start off. First of all, the session is being recorded, and a link to the recording will be sent out in the next few days. This will allow you to view again if you so wish, or just as importantly, to share with colleagues and friends who you think might have a particular interest in today's session. Second, there will be a Q&A session with the panel during the course of the webinar today. You can use the Q&A chat box on Zoom to put your questions in, and you can do that at any point during the webinar, so please do put in your thoughts and questions, and we'll try to get through as many as we can in the time we have. So that's it from me in terms of setting the scene, and I'd like first to invite Ali Al-Zaruni, Chief Operating Officer of DIFC, to set the scene. Alia, over to you.
Thank you so much, Mike. This is my favorite image of the gate building, all covered in green. Good afternoon, ladies and gentlemen. Thank you all for joining us today to move the finance industry from promise to action. I think it's about time. DIFC, the leading financial center in the Miasa region, continues to lead the way for sustainable finance, nurturing action rather than talking. We have worked on so many initiatives since inception to promote sustainability and ESG. In 2006, DIFC, supported by the World Bank and the OECD, established Hawkama as the regional hub for governance with a focus on Miasa. We took that a step ahead by establishing the first ever MENA ESG index in 2011 in collaboration with S&P Dow Jones Indices. DIFC has also established and chairs the Dubai Sustainable Finance Working Group, the first and the most active industry group delivering action on climate change. Our DIFC Academy has been also a great advocate of sustainable finance through carefully selected courses and programs to educate the finance community and beyond. And of course, our path to COP28, the first and the largest finance-focused campaign for COP28 with the Global Ethical Finance Initiative, hosting a series of summits, roundtables, and capacity building sessions throughout the UAE's Year of Sustainability in the build-up to COP28. This is just a few of so many things that are happening really to support sustainability, sustainable finance, climate change, and many other issues around us. I look forward to our panel discussion today. We have amazing, as Mike said, lineup of speakers and experts. Before I end my short note, I would like to take this opportunity to thank our partners for the event today, the IIF. DIFC has been home to the IIF for many years, and we value their role in evolving the industry's perspective on sustainable finance. The Global Ethical Finance Initiative, our path to COP28 partner that runs for 12 months up to COP taking place in Dubai by end of November. And of course, ZGN, a leading think tank from London, which has recognized Dubai's position as the region's leading financial center through its GFCI rankings. Thank you so much, and I look forward to hearing from the experts.
Well, thank you so much, Alia, for that introduction. I'd like to invite now Sonia Gibbs, Managing Director of the International Institute of Finance, to provide a perspective on where we are and the themes that are facing the world of finance as we move forward, particularly with COP28 coming up in just a couple of months' time. Over to you, Sonia.
Thank you so much, Mike, and it's a real pleasure to be here. It's, in a very real sense, this discussion today is an important part of the road to COP, as you say, sort of bringing together the Dubai International Financial Center, the Global Ethical Finance Initiative, and in fact, I would argue the only way that we're going to achieve the world's climate and sustainable development goals is by ensuring this sort of sense of common purpose between long-term business strategy and responsible investment. So the DIFC and the EFI, it's really very common purpose here. We have the right people around the table. So I represent the Institute of International Finance, the IIF. We have over 400 members in more than 70 countries across the whole spectrum of financial firms, banks, insurers, institutional investors, pension funds, sovereign wealth funds, consultants, law firms, the whole gamut. So we really do represent the deep well of global capital that we need to tap and finance the net zero transition. But over half of our members are from emerging markets. And of course, one of the central challenges of climate finance is to ensure that we get enough climate finance to emerging and developing economies, the great majority of which are highly climate vulnerable. So figuring out how to mobilize and channel private sector capital for sustainable finance is absolutely vital. And increasingly, I think we're all focused on transition finance. And that encompasses sort of your high-tech climate solutions, as well as traditional green finance to support companies and industries that are already well aligned with net zero goals. However, transition finance also includes the much bigger swathe of companies and industries that might currently be some shade of brown, but aspire to become green and have plans in place to do so. When you consider that how much of the global economy is based on fossil fuels, business models, economies, transportation, to change all that around is going to require mobilizing tremendous amounts of this particular kind of transition finance from brown to green. And these companies can't do this without advice, guidance, and funding. And this, defines the role of the financial services industry in the next few decades to help these companies transition. It's going to be the heart of transition finance along with managed phase out. All this, though, requires planning. And when we think about the landscape for transition planning, there are three basic challenges to the financial sector. First of all, we are not in the driver's seat here. Transition requires a whole economy approach. So how fast we get to net zero is going to depend mainly on the effectiveness of government policies. So not just for the financial sector, not just regulation, but across all industries. Second, finding global consensus and alignment on financial sector policy and regulation around climate risk and transition planning is really difficult. This is already resulting in fragmentation, including in very important areas like approaches to the use of the capital framework, disclosure, taxonomy, and consumer protection. And fragmentation is already very visible as major economies pursue nationally driven climate and industrial policies, something we haven't seen for many decades. For example, the US Inflation Reduction Act, which has nothing to do with inflation, but everything to do with incentivizing climate finance. And the EU response to the US IRA, including the Net Zero Industry Act, the Critical Raw Materials Act, and the Green Deal Industrial Plan. So quite a lot going on as regions and countries try to steer transition. You could almost think of it as a climate investment race, and that's going to have global consequences. With wealthy countries all seeking to come out on top, it's going to be very important to ensure enough climate finance also flows to emerging economies And that's a big concern, as capital flows to emerging markets in general have been under pressure in an environment of rising global interest rates and geopolitical tensions. So all told, 2023 really has been the year of transition planning and finance. And one of the challenges for the financial services industry, of course, is to manage all these multiple sources of guidance on transition planning. So you've got science-based targets, you have the Glasgow Financial Alliance for Net Zero and all of its sub-alliances, and increasingly, and this is very important for us, interest from regulators in developing guidance and rules. So when you think about it, financial firms have been making rapid progress in developing capabilities and business strategies to support the financing needs of an economy-wide net zero transition. But there are practical limitations on the financial sector's role which should be considered in the context of policy frameworks and supervisory and regulatory approaches to transition planning. Markets for transition plans are exhibiting dynamic growth, so building on sustainable finance markets, even though it can be very challenging in some aspects as the ESG agenda becomes politicized in some jurisdictions, including my own home country here in the States, and increasing risk of climate-related litigation. So there are some headwinds we need to cope with. To illustrate, on the political front, a recent survey by the Conference Board of U.S. firms of more than 100 large companies, almost half of them said they'd already experienced ESG backlash, and over 60% expect it to persist or intensify in the next 2 years. Almost 30% of companies are cutting back on external communications on ESG, so what they call green hushing. Institutional investors are being hit on all sides, so they're the targets of anti-ESG campaigns to disinvest funds, but their upstream clients are also looking for more of a say in voting decisions. So it's really very difficult with these rise in shareholder proposals for institutional investors. I'll just mention briefly some of the many types of litigation risk that are of concern for companies. You have traditional litigation related to emissions and other pollution, greenwashing, transition washing, risks around disclosure. You know, what if, despite your best efforts on ESG disclosure, it proves to be inaccurate? You know, could you face litigation? So when the SEC, for example, put out its disclosure proposals, there was a lot of requests for safe harbor from this kind of litigation risk. Antitrust and collusion risk are a big factor, particularly in the US. You have this sense that when financial firms are banding together in an organization like GFANZ, for example, that could be construed as collusion, even though it's in an incredibly worthy cause. You've got litigation related to defunding. You've got personal liability of boards for climate and environmental risks. You have human rights litigation risks. So the list goes on, but it's an increasing focus for many in the financial services industry. So in this very rapidly evolving landscape of market-based frameworks, official sector policies and regulations and stakeholder expectations for transition planning, what we see and what we're concerned about is the risk of fragmentation and the increasing costs of scaling up capital for transition investment. So what we really hope to have and hope to see is strong and pro-growth policy frameworks at both national, regional, and global levels. And that's got to provide the foundation, the long-term orientation, and the right market conditions to mobilize private capital in support of a net zero economy. And progress is being made both by financial firms and by regulators and supervisors. There is a lot going on the financial sector side. If you look at a survey that we conducted of banks in our membership, 2/3 of them say that they've made moderate progress on climate risk management. Many have started. Over 1,500 financial institutions disclose based on the TCFD framework. European banks have begun Pillar 3 disclosure, and 8% of the financial firms in our survey have voluntarily undertaken or in the process of undertaking climate scenario analysis. At the same time, regulators and supervisors are taking a growing interest here. The Ball Committee, many jurisdictional regulators have published climate risk management principles, climate and sustainability disclosure frameworks, and here I would cite the tremendously important work of the International Sustainability Standards Board, which just released its ESG disclosure standards this June. Exploratory scenario analysis, many supervisors are conducting this, and transition planning. It's just of tremendous interest everywhere. So let me conclude. I know we've got quite a lot of discussion to do today and a great panel ahead of us. There's a really important debate evolving about the role of financial institutions in supporting the net zero transition. How do they maximize the decarbonization impact of what they're doing, recognizing the broader economy-wide factors and constraints that kind of set boundaries on how financial firms can really influence the transition in the real economy? Private financial institutions, in a study that we did with McKinsey, we find that they could provide roughly 40%, almost half, of the $9.2 trillion a year needed in investment between now and 2050 in order to support a global economy-wide transition to net zero. However, it's really important to note that financial institutions have limited direct access, direct influence over the emissions reductions of their clients and investees. This is really an important point. So I want to reiterate that. There's a limit to what financial firms can do to directly control what their clients and counterparties and supply chains are doing across the world. So what financial institutions can do on transition planning is directly related to what their clients and counterparties are doing. So really what we say is that transition planning is a dynamic business exercise to operationalize a firm's strategic, voluntary targets and commitments to achieve low carbon goals. We don't need multiple rules of the world. We need harmonized and well-aligned international rules of the road for transition planning. And standards for evaluating credibility of transition plans are rapidly evolving as well. So in this changing landscape, I think it's going to be tremendously important to see collaboration between public and private sectors in order to achieve our key goals, sound transition plans, and mobilizing private capital at scale to enable the net zero transition. I'll stop here, Mike, and hand back over to you. Thank you so much.
Well, thank you very much. And it really does set the scene, but also some of the challenges that are faced by people in the financial industry, but also people in a range of industries in moving forward. I'd like to now invite Omar Sheikh, Director of the Global Ethical Finance Initiative, for his initial thoughts on trends, issues, and challenges as we move forward to COP. Omar.
Thank you very much, Mike, and thank you, Sonia, for that fantastic presentation. Really laying setting the landscape and the challenges that the sector needs to address. And I think, Sonia, it's compounded as well with the two additional narratives that we see around transition being there is no net zero without nature and biodiversity being addressed. So now we need to go into that world of TNFD and ensure that the rate at which species loss and biodiversity degradation is happening is halted or reduced considerably. Whilst we might sort out the greenhouse gas issues, if we do not sort out the biodiversity and species loss, it'll have huge impact on our supply chain in the agriculture sector and many others as well in core key commodities. So we see a compounding of challenges there, particularly in that world. You don't have a singular currency unit as you'll have for greenhouse gas or carbon, for example, as you'll see in net zero space. In addition, of course, we're also seeing, and we saw this very fervently playing out, Mike, at COP27 about the just transition and ensuring exactly as Sonia was saying about the global south, that it receives the investment, the capital that it requires, be that for adaptation or be that even for loss and damage, as was a big discussion point at COP27. So it is fundamentally, systemically will require all the efforts, all the talent, and very much agree with something that keyword is collaboration to ensure that we can get that transition and we can collectively reach these net zero targets that we have, which are now actually even, to reach the targets. I was on one of our sessions the other day, and it's not 2050 because we've overshot the current trajectory. It means we really need to reach this by, I think, 2042, someone was saying the other day. So it's become even more pertinent that we apply the urgency to this issue. We are hitting, as you'll see, from the news nearly every fortnight, a number of ecological boundaries and tipping points. So without the focus and attention this deserves, the fear is when you have these targets, long-dated targets, the way financial markets, as we have been operating over recent decades, the short-termism that's inherently within, and the structural lack of consideration of the negative externalities on the environment, be that from our accounting standards or be that just from the way the narrative is being dominated by shareholder returns. These issues really need to be addressed if we want to ensure we can reach the net zero, but in a way with the least amount of disruption to business.
Thanks so much. Really good set of opening thoughts, and the question of biodiversity in particular and nature, I think, is one which finance has given less attention to and really needs to continue the current initiatives to move that forward. I'd like to invite Christian Kuntz, who's the Chief Strategy, Innovation and Ventures Officer for DIFC, to provide a kind of regional and financial centre perspective. Christian, over to you.
Yeah, great. Thanks a lot. I'm glad to be here, and so far I think very insightful conversations and presentations. I'll start off with a bit of the larger context and then narrow it down into the regional perspective. But I want to make 3 points that are a big priority for the DIFC and for all of our efforts that we're doing in the context of sustainable finance and moving the industry as a whole from the promises and the needs to the actual action and impact. The first one is around the actual financing itself. So to date, we've seen around 2/3 of all climate financing coming from public sources. And we see private sector financing growing. And I think this is really one of the most critical points. And as DIFC, we're focusing on how can we enable private financing to grow as a key priority. And I'll talk a little bit more about what we're doing in this space. But one of the key priorities and expectations for COP28 is an even bigger focus on enabling the private financing of climate and sustainable finance. The second is, as we know, we heard some of the numbers of the financing that is required over the next decades in order to meet our 1.5-degree targets. And that is a really big and heavy lift. We would need to triple the amount of sustainable and climate financing every year to achieve that. So this is something that requires a fundamental shift in the approach. But what's even more critical in my view is to get the Global South to be part of this. So we know that only 27% of the Global South's financing needs in context of the transition have been met so far, compared to 75% in Europe. So the heavy lift is really in creating access to sustainable finance and to capital markets for the Global South. And this is where Dubai, DIFC already is today and is looking forward to play a bigger role to channeling this financing through Dubai, through the DIFC to the Global South. So that's a really important piece. And one element of this is obviously Nasdaq Dubai. Nasdaq Dubai plays a critical role both in the regional sustainable finance market, but also in the global sukuk market. And I think that's the third point I want to make. In order to not just enable financing and channel it to the Global South and create access, we also need to enable that. We need to develop and further grow the Sukuk market as a whole, and specifically the sustainable climate or green Sukuk market together. Nasdaq Dubai today is the largest exchange for sustainable Sukuk in the world. And so this is obviously a big priority for us and for our partners to further increase. The positives, if I look at a few numbers, is that in 2022, 34% of debt capital markets on Nasdaq Dubai were green or sustainable versus the global average of 11%. So the foundations are set, and now it's about how to scale the market and how to take the different stakeholders on this journey together. I'll hand it over to Mike, and then in the conversation, as we continue, I can discuss a bit more on the specific things we're doing in the region to address all of these 3 points.
Well, thank you very much indeed for that overview. And I think this question of the global north, global south, and how we address this is really important. And one of the things that we've been thinking about is the whole question of transition paths. And every company, every country, every sector will have its own transition path, some of which might mean burning more carbon over the initial period before carbon starts reducing. How do you think we can, the financial world can help deal with that difference in transition paths between different economies, different countries, different sectors? Either Omar or Christian, have you got a view?
Happy to. We'll give some initial thoughts. Look, we do have this challenge. There's probably 30 plus different taxonomies in play right now, Mike, around the world. And we also have to remember, and someone made this point very robustly in Egypt, that the net zero was a global net zero. So exactly as you said, Mike, there's different transition paths for different countries. Some countries might end up positive over a longer term period than others. But it's the global net zero that really counts. And that's where the kind of injustices kick in, as well as to who's contributed to where we got to today versus who needs to adjust going forward, and the impact, as you very rightly noted there, on their own economic development. But look, I think it needs a tailored and a nuanced approach. It needs a collaborative approach, as Sonia was saying. That's why for us, it's the path to COP28, where we're bringing together different stakeholders from around the world. And it needs that realization that people will go at different paces across that journey. You cannot expect or force, as that kind of standardization too early. I know financial services as a sector, we love things being standardized, and that enhances global flows. But in this scenario, I don't think getting that in too early could be counterproductive. I suspect when you force your taxonomies on other regions, and your approach, I think you need to be more delicate. And I think you need to speak the language of different regions. So I think, for example, PIFC sits at this beautiful crossroads between the East and the West as a region. Christian, you're talking about Sukuk there. So if you look at the Islamic finance market, a 4 trillion market, its innate principle that the faith-based form of finance is one of stewardship, whereas it can be doing a lot more in the green and sustainable finance space than it is doing to date. But how often is it included? Where was the voice of Islamic finance when it comes to the sustainable development goals? So I think being inclusive, Mike, having everyone at the table, so when the global standards, whatever they may be they transition pathways or be they PRB or the SDGs, everyone feels like they have a voice at that table and they can contribute.
Well, thank you very much for that. Christian, do you want to add to that?
Yeah, I think I agree with Omar's point, but a few things I could add maybe on top. I think it's on one side, sectors will have to transition at different pace, and they are at different baselines. So that's right, Mike. Also, countries are at different maturity in terms of not just their plans, but also their capacity and education. And so I think both is very important to keep in mind. For me, in this context, there's 3 really important things. One is data. So I think one of the most important things, especially in our region, is to create transparency and create the data that is required to, on one side, understand the baseline, as well as understand the challenges and the paths and the transition paths that different sectors and different companies have to go through. So data is very important. Getting the data, using the data in the right way, and hopefully using now also artificial intelligence to do that faster than we've done in the past, because we're really running out of time. The second is, I think, standardization, like Omar mentioned. I think standardization is important to make it comparable across borders, across sectors, and to make it easier to also share learnings and share best practices and make this transition more cost effective as well. Because one of the biggest hurdles is actually the cost to get onto these journeys in many cases, because it's very tailored and not yet a standardized, easy process. And the last and most important is always people. So in our perspective, it's all about the individual people that are running the businesses, the policymakers, as well as the new generation that needs to, from day one, think about sustainability and understand what needs to be considered. And there's two aspects: one, really building the technical capabilities, and on the other side, making sure that we all talk about the same things, to get a common understanding, and that to make sure that we're the board, the leadership team, as well as the managers understand and speak about the same things. And there's a number of things that we're doing with the GEFI Academy, that we've done with GEFI together in terms of the climate finance training. And I think this is really where we're very passionate to further build capabilities. And with this, hopefully create synergies across sectors and across industries to accelerate the transition.
Thank you very much. We have a question from Hessa Malika asking about the push towards climate investment from governments, and just asking what's the position of small industries. Will the government action lead to the neglect of small industries due to the challenges they face in transition, and how do we tackle this? And Sonia, I thought you might have some thoughts on this.
No, happy to comment. It's such an important point. Small businesses, the SME sector. I mean, this centers around parts of the global economy that are difficult to finance in any circumstance. So you're talking about emerging markets, you're talking about small businesses where we have even less data. Christian, you had mentioned the data point. It's even less available for small and medium-sized enterprises. And it's also much more difficult for them to be in compliance with the appropriate disclosure regulations and so on, to provide the kind of information about their sustainable finance and their transition goals that investors need to be able to finance them. So one of the points I wanted to make is the importance of de-risking finance. When you're talking about sort of higher risk clientele for the financial services industry, whether that's emerging markets or small businesses or new industries that are unproven, new technologies, all of this is risky finance. And in order to scale risky finance, you need to find de-risking tools and solutions. And one thing I wanted to mention here is the importance of, they call blended finance. So putting together public, concessional, even philanthropic, plus private finance. And this is really going to be one of the key unlocks to getting private capital at scale in support of transition. Again, it's a challenge, right? Because blended finance works very well in bespoke individual projects. And Omar, I think you'd been talking about the challenges of standardization, nowhere more so than in blended finance, where these deals are so intricate that it's very hard to kind of set out a general term sheet and conditions that everybody could use and make it easy to do this. But nobody said this was going to be easy. It's going to be a challenge for all of us. But you're absolutely right, Hessa, to focus on the needs of small businesses in particular. It's an area we've really got to work hard on, because in many parts of the world, small businesses are the bulk of the economy. So it's a super important point, and thank you for raising it.
David Jones has raised an issue about voluntary carbon removals and where the investment might sit in what the investment strategy going forward. Why are people not investing in carbon since the price of carbon is going to rise? And this brings to the question of both the voluntary carbon markets, but also the traded carbon markets, ETS systems, and different forms of investment. I mean, we've done quite a lot of work on sustainability-linked bonds, which kind of tie the policymakers' hands in terms of future policy. And we've seen last year both Chile and Uruguay issue sovereign sustainability-linked bonds, which ties future political policy towards carbon reduction. But just be interested in all of your thoughts actually on where the carbon markets and carbon investment sits as part of the strategy of dealing with the climate issue. Sonia, shall I start with you? I know you may have to leave quite soon.
Sure, I'll say a couple of things. And this is a real year of progress for voluntary carbon markets, not least because the COP28 presidency has been very focused on this issue and is going to be making some announcements at COP. A lot of things have happened. You've got the Integrity Council for the Voluntary Carbon Market. I'm a board member of that group. It was launched by Mark Carney in 2020. They've come up with standards on the supply side. So you've got to have integrity in the actual credits and the offsets that they're used to generate from. And that requires good governance around the projects, the carbon offset projects, and a lot of which are located in emerging and developing economies. So the supply side is one piece. The demand side is another piece. So how are companies using these offsets? Are they reporting them correctly? Are they being appropriately used? And here the Voluntary Carbon Markets Initiative, the VCMI, has come out with a claims code of practice. So bringing together demand and supply side integrity, because it's really important to get confidence in the voluntary carbon markets. Over time, what we need is kind of interoperability between voluntary and compliance, the ETS that you mentioned, markets, so that they all can grow and be an effective substitute for a global carbon price, which is tremendously difficult to achieve. But really important efforts on all fronts.
Thank you. Omar.
Yeah, I think I'll probably pick up on a couple of points. One is, I think Sonia's mentioned key elements there, which we're seeing integrity very much sitting at the heart of this, where these voluntary carbon markets are based, where the capital actually moves as well. And there's also some ontological considerations around the offset mindset as well, and how we calculate carbon credits in the first place. So there has to be some intent, whereas, to change a status quo whereby you'll get awarded a credit. So that unfortunately has come together in a way which has meant less than 5% on your global capital through carbon markets is flowing to places like Africa and so on and so forth. So it does need to be assessed from that perspective as well. And again, also the offset mindset as well, versus reduce and reuse and just ultimately ensuring that we go to a real zero rather than a net zero. Mike, we can't dismiss that and just be happy with, okay, we're reporting and we're net here. But I think also the point that both yourself, Mike, and Sonia made around blended finance, I think that's where the innovation really needs to come in, where we need to change our mindsets and move beyond just the traditional metrics that we use, be willing to be innovative and really genuinely test out some of these different financing structures. I think it is obviously different to VCM world, but the point is the principle behind it, innovative, creative, structure, financial engineering and structure sits at the heart of many of the challenges here that we have if we want to really address climate, nature, biodiversity, and people. So they're included in this transition. Thank you,
Christian.
Yeah, I can only echo what was said before, but I would say, I agree, and it's very important to make sure, especially in the emerging markets, that carbon markets are an important tool, but they're not the solution. And you have to start with, setting your own, measuring your own baseline, developing your own decarbonization strategy, putting your targets, and then having this as one tool. It cannot be the starting point. And I think that's very important, because I think especially in markets where, let's say, the maturity of sustainability and climate strategy is still early, this is a very quick way of kind of going into the wrong direction. So I think it has to be looked at very, very well. I think the projects are important as well. I think more projects also, the more projects we can establish, local projects as well, will make this also more tangible, more real, and easier to govern. So I think there's a lot to be done. It's an important tool, but we focus a lot in the education of setting your strategy and having a clear strategy on decarbonization, as Omar said, and having the right means, and then using this as a tool for transition. The second thing, just to echo or to maybe add to the point on SMEs. SMEs are absolutely critical. I think there were some questions also on startups and fintechs. And this is a big priority for us as well. So just to mention to anybody on the call, the Dubai Sustainable Finance Working Group we created jointly, also endorsed by the United Nations, ESG maturity self-assessment tool that can be downloaded on the website if you search for Dubai Sustainable Finance Working Group. This is a non-threatening tool. It's free to just get into the ESG and sustainability journey, to understand what are the dimensions, measure your own maturity, and start walking that journey without spending a lot of money, with just getting started. And I think the focus for this tool was primarily on the SME sector, because it's a long tail, it's an important one. And so we're creating a number of tools and reports that are really focused on the education capacity building of those important companies. The other thing we've done in that context as well is jointly with the MENA FinTech Association, we created a Sustainable FinTech Alliance. It's also endorsed by the Ministry of Climate Change, where we trained actually the founders of these new fintechs and startups to understand sustainability and how to integrate climate and sustainable thinking into their business from day one and into the solutions that they're building. So I think extremely critical to take the SMEs and the startups onto this journey, although they might not be the biggest contributors today, but they can play a critical role over time, and we need to start doing a lot with and for them as well.
Thank you. And you're right, there's a few questions coming around how the IFC is helping to ensure that the word is spread, but also questions around how fintech and AI can help in the measurement of ESG reporting. And I know there are certainly in London a number of fintechs who are specifically aimed at helping companies identify their various types of scope of emission. But just wondered whether anyone had thoughts about the role of fintech and technology digitalization in helping to track ESG reporting. Christian, you might have a view, I think, from the IFC.
Absolutely. If you want, I can start off. Obviously, at the core of everything is payments. So when you think about the different spendings companies do, it is always coming back to payments. So there's a critical element of measuring spending and related carbon footprint through the actual payments that companies are doing. And we're seeing an increasing number of startups or fintechs specifically taking that on and trying to not just trying different ways to support that existing infrastructure, financial infrastructure, to make it easier to measure the actual data that is required for the financing and for the transition. That can include measuring actually the spending and then converting that into a carbon footprint. This can include companies that are trying to enable the end consumers to offset that as part of that payment journey as well. And so I think there's a couple of really interesting solutions that is being worked on, and also solutions that are quite inclusive, because payment gateways and other ways of payment are integrated not just with the big companies, but also with a large tail of SMEs, as we just discussed. So that's one example that I've seen, and I think we're still in the early days, but I see that it's picking up, and I see a lot of the companies and startups also really embracing this trend.
Thank you very much. Just moving on, we've got a question from Deo Ajay Obi asking about how to separate the emissions from conglomerates and multinationals in the global north who are doing business in the global south from direct emissions from the global south. And while Scope 3 is supposed to deal with some of this, how can we also encourage the conglomerates and multinationals from the north to transition into green technology in the global south? Sonia, I think you might have some thoughts on this.
Yeah, I'm happy to take a crack. And Christian, you probably want to add some thoughts here as well, and maybe Omar. Look, I think the measurement of emissions and the measurement in particular of scope 3 is one of the most challenging tasks facing us. There's a whole swathe of companies out there to sort of provide solutions. The difficulty is that there isn't an accepted central methodology for doing this. So you've got a lot of different approaches to it, and that encourages companies to think about, whether when they're reporting this, could they be accused of greenwashing and so on. Look, I think it's not so much a question of the Global North taking advantage of this, but rather how to calculate all of the different supply chain emissions and how to enable, as you say, the Global North to channel the kind of finance into green technology in the Global South. And it's one of the most challenging things as well about the accounting for carbon offsets and carbon credits as well, because exactly what are you tracking? So it's not an exact science. Advances in technology are going to help, but again, I would go back to the question of directing finance where it's needed. You make the very good point that we need that financing for green technology, especially in the Global South. Carbon markets can be one way of doing this, but solving the accounting puzzle and the risk measurement, the emissions measurement problems that you cite are central to solving that problem.
Yeah, I mean, I can maybe add two more thoughts on this topic, a very important one. I think obviously policy plays one role in this, and as policy is evolving, especially in the Global South, I think we'll see some more, let's say, alignment on global standards on this across the world. And on the other side, I think innovation is very critical as well. And for us, innovation, unlocking innovation to make this actually the more attractive solution. And as a default, especially in new markets where you're going in with new investments from day one, not even considering alternatives, I think are two pathways that are important to follow in this context.
Mike, can I have one more quick point here? And that is that a lot of the challenges with voluntary carbon markets are around, as I said earlier, the governance of the projects in these emerging and developing economies that don't necessarily have the infrastructure, the capacity to do this well. And one very encouraging part about the development of voluntary carbon markets is that it kind of brings in private sector conditionality and private sector capacity building in emerging economies, almost like technology transfer, to complement the role of the multilaterals and the development finance institutions that have been doing this for so many years. So hearing directly from private sector investors what they need in terms of impact assessment, in terms of being able to know that their money is being put to good use. I think it's an important part of the new world of sustainable finance.
Yeah, and John Taylor just in the comments has noted the multilateral development banks have been using blended finance, for decades. They've got real expertise, and bringing that expertise in is really helpful, and making sure that everyone's working together.
Well, the Network for Greening the Financial Systems, the NGFS, is doing a handbook on blended finance this year to put out at COP, and that brings together private sector and the MDBs. And, as you know, John, there's a lot of conversations around this. So this is the year of spurring on blended finance. You make a very good point. We need to get the experts together and on the same page.
Yeah. Omar, have you got any thoughts on the discussion just now?
Yeah, I think most points have been covered there. I mean, just going back to the kind of the data side, Mike, you were talking about the data side. I think, look, what some interesting trends we're seeing here in Scotland. I mean, we're seeing satellite data increasingly being used to capture key information metrics. I think Glasgow as a city is one of the world's kind of biggest producers of satellites. We're seeing how the data providers are also kind of scrubbing the net, obviously, as they have been for years, but with AI, their capacity to bring in that big data is phenomenally enhanced. The use of apps, I think, Christian, you referred to where each one of your transactions you're getting a kind of indicative carbon footprint against it. So each individual consumer can begin to measure and track where they're getting too much kind of fast fashion or they're spending too much on petrol or whatever. So in light of their kind of own personal kind of carbon targets. Tailoring as well. The tech allows a phenomenal amount of tailoring as we go to kind of more stakeholders going online onto their apps to decide their own investment strategies, personalization, tailoring. So that is really exciting as well. But I still think though, net we mustn't forget from a data point of view, when this comment came up last year at our Global Ethical Finance Summit, which we host every year in Edinburgh. Next week is this year's edition. But last year, Mike, a comment came out around data, because we know there are contradictions. Let's not forget the elephant in the room. There is contradictions between data providers and how they put the ratings out. There's a black box mechanism. You've had companies in the top quartile for their sustainability ranking getting sued and litigated against for terrible practices on the S, whereas they're top in the E. So there is this challenge here. And we must remember, data is a tool here. We shouldn't be, quoting one of the speakers last year, we shouldn't be measuring ourselves into extinction. That's the way it kind of seems when we have this fixated view on the data. It is what it is. We are where we are. It needs enhancing, but it is a tool to help us on that journey. It doesn't become the end. Right.
Thank you. I'd like to turn to the question of actually how can finance and financial centres influence the policy agenda. We all know that sustainable finance is going to be driven by policy decisions taken at government level, and increasingly so. How can finance best influence the policy agenda, I guess? Christian, I'm going to start with you. The IFC, one of its jobs is to influence the policy agenda by bringing together the private and public sectors. How does finance make the case?
Yeah, it's a great question. I think global financial centers play a very critical role, especially the ones that are quite well organized, like the DIFC. So we have over 600 financial regulated institutions across banking, capital markets, wealth and asset management, and insurance. So we have all of and it's quite an international footprint. So we have 25 of the 30 systemically important banks. We have key banks from the west, from the east, from the north, from the south. So it's a very diverse ecosystem of international banks and regional banks and financial institutions that are operating in a very close environment and engaging with each other on a daily basis. And so the benefit of that is that we understand and we have constant engagement with those individuals driving the strategies and the agenda of those international organizations in the region, as well as with their international counterparts. Most of the participants, for example, in the Dubai Sustainable Finance Working Group, will not just put their regional lead for sustainability into the group, but also pull in their international experts in many of the topics. And so that exchange is extremely valuable to understand where we can learn from internationally, as well as share and understand the local challenges and the regional challenges and find joint solutions. And so I think from a policy point of view, we've been actually as a financial center listening a lot to the private sector, both the regional and the international perspective. And we're trying to learn from what we see internationally to really try to simplify and to merge standards and bring together kind of not additional complexity, but rather reduce the complexity. And so I think that's a very, very, very good ability that a financial center like the DFC has. The second is then to not just create the policy, but also create tools, vehicles, and forums like our Dubai Sustainable Finance Working Group, as well as our Future Sustainability Forum, as well as our partnership with GEFI on the path to COP28, where we then can translate the policy and the global ambitions and the regional ambitions into actual knowledge sharing, practical tools and reports and action plans that will help those change makers really to move into action as we actually as the webinar is trying to discuss. And so I think the benefit of the financial centers is to mobilize the industry and to create groups that can exchange and help each other to accelerate on this path. And I hope to see that more internationally. I know that not as many global financial centers are organized in the same way, and I think we can hopefully share some of the learnings and practices that we're doing here in Dubai with others as well.
Thank you very much. Other thoughts, Omar?
Yeah, Mike, I think, look, it's three very simple things for me. Number one, financial services, the market moves in two ways. One, what the regulator and compliance dictates, and the second one, what the customer or market demand is saying. On market demand, let's not forget, last year was a key milestone. Over 1.1 trillion was spent on transition finance, which is equivalent, if not slightly more, than the amount of money spent on traditional oil and gas. So there is market demand. This is a great space to be in, very important. Number two, is the regulation. And of course, there's a role for setting the reporting, the compliance requirements, everything around here. So Egypt hosted COP27 last year, and then they implemented TCFD immediately thereafter in the region. So that's number one. And I think that regulation space is very, very important. The other two areas I think are also very, very astute and tactically critical as well to be successful in this journey. Number one is creating the space for intellectual discourse. This world that we're moving on sustainable finance is beyond climate. There's other components, and traditionally in the financial services world, we're very much quantitatively driven. We now need to understand and unpack the S in ESG if we want a just transition. So where do we get the skill sets for unpacking these qualitative factors by nature? So that's why Path to COP28 advocacy programs are absolutely critical. And the last one, Mike, I think is very important, is setting the tone. What is the tone? What is the ambition? Ensuring there's authenticity, and as Christian was saying, this concept of genuine collaboration, the innovation, like you were saying, Mike, around social impact bonds or performance-linked bonds, that sets the tone massively for that jurisdiction and for that center. And ensuring that, as the title for this event says, ensuring that there is urgency, promises to action. We really need to move rapidly towards financing our own survival, I would say.
We are rapidly running out of time. There's a question in from Antish Gautam about how would we propose investment in green technology for the global south. And just to highlight quite an interesting development from Germany, actually, a group called the Global H2 Stiftung is guaranteeing a hydrogen price, so that it's one of the difficulties of developing, for example, hydrogen plants in Africa would be, okay, well, will I get paid long term? But actually the Stiftung is creating a long-term price guarantee for hydrogen, which gives people some certainty in terms of their investment in new technology. And to say that, of course, in renewable finance, there's several countries across the south who've made incredibly fast shifts towards renewable finance without having to do anything special. People just see that it is investable, it will make money, there's a return on investment, so off we go. We only have about a minute left, I'm afraid, so it's just for me to first of all thank you for turning up and for participation, for your questions and engagement. It's been a fascinating session, and made the more so by an audience who is engaged. But really to thank very much our contributors today, Alia Al-Zaruni, Omar Sheikh, Christian Kunz, and Sonia Gibbs, for giving so generously of their time and expertise on something which I'm sure will continue to engage both ourselves and the audience going forward. So thank you very much for that. Normally on a large-scale presentation, I'd throw the floor open for a large round of applause. I can't do that today, but the thought is there. Thank you very much indeed, and we look forward to seeing you again. Thank you.
Thank you.
Thank you very much. Bye.